This is the only silver and gold video you must watch for August. Because right now, at this exact moment, two patterns are converging. One is technical, the other is geopolitical. And when they align, precious metals investors don't just survive, they position themselves ahead of what comes next. The first, inverse head and shoulders formations, completed across gold and silver. The second, Chinese accumulation at levels unseen since 2022's turning point. But here's what most analysts are missing. The third catalyst has just emerged, and it's hiding inside Federal Reserve policy, not the rates themselves, but what the market is now discounting the Fed will do. This shift changes everything for precious metals portfolios over the next 90 days. By the end of this analysis, you'll understand the three drivers that signal whether August 2026 marks a structural bottom or temporary relief rally. And more importantly, where serious wealth is being accumulated right now. In this briefing, you'll gain access to institutional-grade analysis that separates signal from noise. You'll learn the technical thesis behind current price targets, precisely where gold and silver should trade if patterns hold. You'll discover the single most reliable leading indicator that has predicted every major precious metals bottom in the past 5 years. And you'll understand the yield curve mechanics that central banks are quietly engineering to reshape portfolio allocation across 2026 and beyond. Welcome to Currency Arc Insight, where serious investors make informed decisions on precious metals and macroeconomic risk. Before diving into this analysis, subscribe to the channel, where every briefing is built for strategic decision makers. We'd love to know, where are you watching from today? The technical landscape of precious metals in August 2026 reveals a formation that market participants have observed only at critical turning points in the past 2 decades. Across both gold and silver, the price structures that emerged during the summer correction exhibit a reversal pattern with specific mathematical properties. These patterns suggest the market has entered a phase where downside risk has been substantially limited, while upside opportunity remains asymmetrically skewed. The most significant observation concerns the inverse head and shoulders configuration visible in both metals. This formation consists of 3 bottoms and 2 peaks arranged in a particular sequence. The initial decline moves lower, followed by a recovery. A second decline pierces below the first bottom. This represents the central low point, or head. The pattern completes when a third decline moves lower than the first, but stabilizes above the head's level. When the formation resolves upward, measured move calculations project how far the subsequent rally should travel. For gold, the measured move calculation derived from this pattern projects a target of approximately $4,400 per ounce. The market has already approached this level, closing on certain days near $4,390. For silver, the analogous calculation points to $68 per ounce. These are not arbitrary price levels. They represent mathematical projections based on the vertical distance of the pattern applied to the breakout point. Precision in these calculations matters because they allow investors to establish risk parameters and position sizing with confidence. The neckline of this reversal pattern serves as the critical boundary. It represents the threshold above which the reversal thesis becomes validated. Supporting this neckline are 2 additional technical anchors. The 200-day moving average for gold sits near 4,180 us, while silver's 200-day moving average trades near $70. Historical price action also reinforces these levels. Multiple prior peaks in gold occurred in a zone around $4,500, establishing this region as a natural resistance threshold. Similarly, silver has encountered significant selling pressure in the $70 to mid-70s range across previous rallies. These overlapping levels, the measured move target, the 200-day moving average, and prior resistance zones, create what technical analysts recognize as a cluster of resistance, a zone where traders historically pause before committing fresh capital to the upside. Beyond the pattern itself, the momentum profile in precious metals equities tells a parallel story. When examining the 1-week rate of change metric for gold mining stocks, recent weeks show gains of 15 to 20% compressed into 7-day periods. This represents significant momentum. However, the context matters enormously. This momentum has materialized following a 40% sector decline. Historically, when such extreme momentum appears after steep losses, the interpretation depends on what preceded it. If such momentum appears at the tail end of a major rally, it signals exhaustion, a blow-off pattern that often reverses sharply. But if this momentum emerges after a prolonged decline, when the sector has already experienced substantial destruction, the evidence shifts dramatically. Historical analysis of comparable periods in 2003, 2008, 2016, and 2020 reveals a consistent pattern. After steep 30 to 40% declines in precious metals equities, 1-week momentum spikes do not reverse immediately. Instead, they signal that capitulation has ended and fresh accumulation has begun. The 2008 correction offers a particularly relevant comparison. The trajectory of that correction, its duration, its percentage decline, and the price action at its low point bears striking similarity to the current formation. The 1973 correction, during which gold experienced a 29% decline before rocketing higher in the stagflationary environment that followed, shows comparable duration and price dynamics to what has unfolded across 2026. The 2006 and 2016 corrections provide additional reference points, each representing healthy pullbacks within a secular uptrend rather than structural breakdowns. Yet technical analysis, precise as it may be, carries inherent limitations. Price patterns and measured moves reveal what the market's price action suggests, but they do not explain why that price action has occurred. A fully convincing bottom thesis requires corroboration from other data sources. The psychological positioning of major market participants, the behavior of institutional buyers, and the fundamental drivers reshaping monetary and fiscal policy all provide independent verification of whether a technical floor is merely a temporary pause or a durable foundation for sustained recovery. The technical picture establishes the framework. Sentiment and fundamental analysis must now validate whether this floor will hold. The relationship between investor sentiment and price bottoms operates according to a principle often overlooked by those focused exclusively on technical patterns. When broad-based pessimism reaches extremes, when professional allocators have systematically reduced or eliminated precious metals exposure, the foundation for substantial price appreciation has paradoxically been laid. This phenomenon emerges not from optimism, but from the exhaustion of selling pressure. The Bank of America Fund Manager Survey, conducted monthly across global hedge fund managers and institutional investors, provides measurable data on positioning sentiment. This survey tracks whether professional capital allocators believe precious metals are valued above, below, or at fair value. The interpretation is straightforward. Readings above a certain threshold indicate overvaluation. Readings below that threshold indicate undervaluation. In recent weeks, the Precious Metals Allocation Survey reached levels not observed in more than 3 years. The positioning data reveals that institutional fund managers have reduced exposure to metals at a scale matching only the depths of the October 2008 financial crisis. This represents a critical contrarian signal. History demonstrates that sentiment extremes of this magnitude have consistently coincided with major market bottoms. When professional capital, the category of investor with the greatest resources and decision-making authority, has fundamentally capitulated and reduced allocations to minimum levels, the psychology required to sustain further selling has already been exhausted. What follows is typically a period of forced capitulation among remaining weak holders, followed by institutional reentry as valuations normalize. The 2008 precedent provides the most direct parallel. At that juncture, when gold's fundamentals appeared weakest, when government intervention seemed to threaten the metal's role as an alternative asset, professional positioning reached similar extremes. The subsequent recovery from those 2008 lows unfolded over years, not months, but the turning point was marked by precisely this type of institutional underallocation. Beyond sentiment surveys, physical accumulation patterns offer direct evidence of where serious capital is being deployed. The People's Bank of China, functioning as the official monetary authority and primary reserve manager, engages in systematic gold purchases through allocated channels. The accumulation patterns reveal a consistent structure. When precious metals prices decline substantially, Chinese central bank buying accelerates. When prices rally, official buying diminishes. The timing is not coincidental. This pattern has emerged consistently across 3 distinct accumulation cycles: October 2022, October 2023, and July 2026. The specificity of these dates matters. Each corresponds directly to significant troughs in precious metals prices. The volume of purchasing authority deployed during each cycle increased progressively with severity, suggesting institutional buyers recognize price levels and respond with conviction. The July 2026 accumulation data, while subject to typical reporting lags, shows accumulation intensity matching or exceeding the October 2022 episodes that preceded sustained price appreciation. Yet official central bank channels represent only a fraction of total Chinese precious metals acquisition. Non-monetary import flows through London's over-the-counter markets provide evidence of secondary accumulation channels. Purchases executed through private proxies, insurance entities, and non-governmental holders. These flows reveal purchasing volumes substantially larger than official central bank figures. When combined with official PBOC data, the aggregate picture demonstrates that Chinese capital, deployed through both transparent and off-balance sheet mechanisms, has been systematically accumulating precious metals, precisely when Western investors have been liquidating. The alignment between these 3 data streams, technical capitulation, extreme sentiment underallocation, and concentrated institutional accumulation, creates a convergence pattern. When Chinese central bank buying clusters occur at price bottoms, when fund manager sentiment reaches 3-year lows, and when technical formations signal reversal, the probability that those price levels will hold increases substantially. The psychology of this transition is equally significant. Market participants classified as permanent skeptics, investors who have maintained bearish precious metals positioning through extended periods, face a critical inflection. As price stabilization becomes apparent and fundamental catalysts shift, the psychological resistance to reversing long-held bearish views collapses. When these holders finally exit short or underweight positions, their forced purchases add additional buying pressure to an already firm technical foundation. The sentiment paradox resolves into clarity. Extreme pessimism, when verified by institutional accumulation and technical support, marks not weakness, but opportunity. August 2026 presents precisely this configuration. The most significant policy shift of 2026 has occurred not through formal Federal Reserve announcements, but through a fundamental reorientation in market expectations regarding monetary tightening. For the preceding 18 months, financial markets priced in a scenario where the Federal Reserve would implement additional rate increases to combat inflation. This expectation shaped asset allocation decisions across all markets. Gold, historically sensitive to rising real interest rates, faced persistent headwinds. However, that thesis has undergone a structural revision, and this revision explains the current recovery in precious metals prices. The transition in market perception has unfolded across several developments. Initial evidence emerged when employment data deteriorated below consensus expectations. Simultaneously, Fed officials communicated a posture toward allowing long-term interest rates to rise naturally rather than intervening to suppress them. Yet markets began to recognize a contradiction within this narrative. If the Fed truly permits long-term yields to rise substantially, the consequences for government borrowing costs and equity valuations would be severe. The Treasury market would face significantly elevated funding costs at refinancing. Equity multiples would compress sharply as discount rates increased. This outcome would undermine the economic stability the Federal Reserve is mandated to preserve. The resolution of this contradiction emerged through a mechanism that operates beneath the surface of official policy pronouncements. When Japanese authorities faced pressure to support their currency, which had weakened substantially against the dollar, they would normally accomplish this through Japanese government bond sales, converted into yen purchases. However, such treasury selling would increase long-term U.S. yields precisely when the Fed wished to maintain borrowing capacity for the federal government. The solution arrived through bilateral cooperation. The U.S. Treasury Secretary publicly announced that American authorities would directly purchase yen, eliminating Japan's need to liquidate treasury holdings. This intervention required dollar creation, effectively monetary expansion, to support treasury market stability under the guise of foreign exchange intervention. This represents yield curve control in practice, though not in name. The Fed explicitly avoids using the terminology yield curve control because such overt acknowledgement would signal that market prices no longer determine Treasury yields. The government policy has assumed that role. Maintaining this fiction preserves confidence in Treasury market functioning. In reality, the mechanism is transparent. Print dollars to support key asset prices, in this case, Treasury bonds through indirect yen purchasing, thereby maintaining yields in a band compatible with fiscal sustainability. The implication for precious metals is direct. If long-term yields are being managed to remain below approximately 5.5%, the threshold beyond which government debt service becomes destabilizing, then gold benefits from this policy regime. However, the manner in which yields move within this band determines gold's performance. Sharp, sudden spikes in yields would prove bearish for all assets, including gold, as capital rotates instantaneously into bonds offering superior real returns. Conversely, slow, orderly curve steepening, where the yield curve gradually tilts upward over weeks, proves bullish for gold. In this scenario, bond investors remain indifferent between bonds and gold, while equity investors find neither asset sufficiently attractive to rotate massively. Gold rises because it benefits from rising yields without suffering the competitive disadvantage that sharp spikes would create. The current regime exhibits precisely this orderly steepening characteristic. The front end of the yield curve, 2- and 3-year securities, has stabilized near 5%, reflecting market expectations that Fed policy will not tighten further. The long end has drifted higher toward 5.3 to 5.4%, but this movement has unfolded gradually across weeks rather than spiking in days. Gold has risen in tandem with these yields, suggesting that capital has rotated not from gold to bonds, but rather into both gold and bonds simultaneously as equities become less attractive. Real rates analysis corroborates this interpretation. When examining gold's performance against foreign currencies, equities, and bonds, a methodology that isolates gold's value in real terms rather than nominal terms, the picture becomes clear. Gold has strengthened substantially against stocks, demonstrating that this recovery is not merely inflation compensation, but genuine purchasing power appreciation. Gold has also outperformed bond yields, suggesting that the asset is gaining genuine demand beyond its historical inflation hedge function. The Fed's policy transmission has shifted. Tightening no longer arrives through rate increases. It arrives through market dynamics that have already compressed equity valuations and tightened financial conditions. Gold, freed from the headwind of rising real rates, can now function as a strategic hedge against policy uncertainty and currency instability. The study of precious metals behavior across multiple market cycles reveals a fundamental pattern. Secular bull markets in gold are interrupted periodically by substantial corrections. These corrections are not aberrations, but structural features of the bull market itself. Understanding which historical correction cycle 2026 most closely resembles determines the probability that current support levels will hold and the magnitude of subsequent appreciation potential. Gold has experienced three major structural breakouts in its modern history. The first occurred in the late 1960s when the metal began its escape from the artificially suppressed $35 per ounce price ceiling. The second emerged in the early 2000s when central banks shifted from persistent sellers to net buyers and geopolitical instability accelerated. The third commenced in the early 2020s, driven by monetary accommodation and inflation pressures. Each of these breakouts has been followed by a significant correction, a retracement that tested the durability of the bull thesis, but ultimately confirmed it. The corrections following these breakouts occurred in specific periods, 1973, 2006, and 2008, for the earlier cycles. When examining the percentage declines and time duration across these events, a striking consistency emerges. The 1973 correction involved approximately 29% peak-to-trough decline over a compressed timeframe. The 2006 correction proceeded more gradually but reached similar magnitude. The 2008 correction, arriving during the financial crisis, produced comparable decline percentage relative to the preceding bull move. When plotted on comparable timescales, these three corrections align remarkably closely with the 2026 correction currently unfolding. However, one historical correction demands separate analysis, the 1975 to 76 event. This correction represents the most severe decline in gold across the entire secular bull market, a 45% drawdown over 20 months. Investors and analysts have periodically warned that current conditions could replicate the 1975-76 pattern. This concern requires careful examination. The 1975 to 76 correction occurred within a specific macroeconomic context that no longer exists. During 1973-1974, the equity market collapsed approximately 50% as stagflation gripped the U.S. economy. This catastrophic stock market decline forced institutional capital out of equities systematically. This displaced capital sought safe havens, and precious metals became the primary recipient of this rotation. By the time gold peaked in 1975-76, the metal had appreciated roughly 700% in real terms. Measured against equity returns, the stock market had been demolished. Institutional capital required somewhere to deploy, and the only answer was equities at depressed valuations. Gold suffered a sharp drawdown because capital rotated massively back into stocks. The current macroeconomic setup differs fundamentally. Equity valuations, while compressed from 2021 peaks, remain substantially elevated compared to historical averages. The equity market has not experienced 50% destruction. Capital has not fled stocks en masse. Additionally, the traditional alternative to gold, long-term treasury bonds, was the source of capital outflows in the 1975 to 76 environment as stagflation eroded bond real returns. Today, bonds remain an acceptable alternative asset, but they are not generating capital flight pressures comparable to the 1970s. Geopolitical instability, while present in the current environment, has not reached the level of disruption that characterized 1973-1974. Price action analysis reveals precise timing parallels between the 2026 correction and its 1973 analog. When examining the intraday low points of both corrections, the 2026 formation has bottomed within a single day to 2 days of where the 1983 formation bottomed when both are plotted on comparable timescales. This degree of alignment suggests that market participants are responding to comparable technical structures, not coincidental similarity. The probability distribution for September price levels reflects this analysis. Should the current support level fail to hold, a descent toward additional September lows remains possible, with the magnitude potentially matching the 2008 correction pattern more closely than the 1973 pattern. However, such an extension would occur during September, historically a month preceding buy season for precious metals allocations, which typically recommences in October. This seasonal context, combined with extreme sentiment readings and accumulated evidence of institutional purchasing, suggests that if September lows materialize, they would prove temporary capitulation points before sustained recovery. The historical record indicates that 2026 rhymes with 1973 in 2008. It does not rhyme with 1975-76. The convergence of technical support, extreme sentiment, institutional accumulation, and favorable policy transmission creates an inflection point in precious metals markets. For serious investors and portfolio managers, this convergence demands a systematic reassessment of allocation architecture. The foundational thesis rests on verification across three independent frameworks. Technically, measured move calculations derived from inverse head and shoulders formations, project targets of $4,400 for gold and $68 for silver. These levels represent not arbitrary price objectives, but mathematically derived resistance zones where the initial phase of recovery should consolidate. Beyond these near-term targets, secondary resistance zones emerge at $4,500 to $4,800 for gold, a zone where prior peaks and structural resistance converge. For silver, resistance enters the mid-70s range, where multiple prior reversals have occurred. The realistic 90-day window allows for measured advance toward these targets without requiring parabolic acceleration. Sentiment verification confirms that fund manager positioning has reached extremes consistent with market bottoms. The Bank of America survey data, combined with the timing of Chinese accumulation spikes, provides independent confirmation that institutional capital deployment has begun. This phase of reallocation typically unfolds across quarters, not weeks, suggesting that positioning flows will continue to support price appreciation throughout the remainder of 2026. For tactical positioning, mining equity volatility presents a distinct opportunity. Because precious metals trade 24 hours daily while domestic mining equities trade only during regular sessions, overnight gaps frequently separate closing prices from opening prices the following session. These gaps create entry opportunities for investors willing to accept short-term volatility to establish positions ahead of fundamental shifts. The historical pattern indicates that steep sector declines of 40%, when accompanied by extreme sentiment and fundamental accumulation, typically precede recovery phases lasting 18 to 36 months. Current mining equity valuations, evaluated on cash flow and reserve bases, reflect Depression-era multiples. Systematic accumulation during this window allows portfolio managers to establish large positions at prices unlikely to repeat. Portfolio construction implications extend beyond tactical positioning into strategic allocation. The role of gold and silver within diversified portfolios has evolved significantly. Traditional correlation analysis treated precious metals as inflation hedges, performing well only when inflation accelerated. Current evidence suggests a broader role. Gold and silver function as genuine portfolio insurance in environments where yield curve control masks the true tightness of monetary conditions. They provide real purchasing power protection when central banks prioritize financial asset prices over currency stability. They offer geopolitical hedging when conflict risks threaten supply chains for critical materials. The current 2026 environment encompasses all three conditions simultaneously. The critical risk variable centers on Fed policy dependency. The entire thesis for precious metals recovery rests upon the assumption that long-term yields remain constrained below approximately 5.5%. If market dynamics force yields substantially higher, if Treasury demand evaporates or inflation concerns accelerate sharply, gold and silver could face renewed headwinds. Conversely, if the Fed accelerates yield curve control mechanisms, if Treasury Secretary intervention intensifies, or if geopolitical disruptions increase flight to safety demand, precious metals could appreciate more rapidly than the measured 90-day targets suggest. Serious investors should recognize August 2026 as a structural inflection point. The convergence of technical completion, sentiment extremes, and institutional accumulation occurs with measurable statistical rarity. The positioning window for reallocation, whether through physical accumulation, mining equity exposure, or strategic option positioning, remains available, but finite. Historical patterns suggest that such inflection points typically close within 90 to 180 days as new allocations become established, and price appreciation reflects the fresh capital flows. The preparation for Q3 and Q4 2026 policy shifts has begun. Investors positioned now participate in the reallocation phase. Those awaiting additional confirmation will participate in the acceleration phase at materially higher prices